Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, a survey done by Sun Life and reported by Bloomberg said 47% of Canadians fear they will outlive their savings. Is that a legitimate fear, and is there anything they can do to not do that, apart from driving over a cliff?
Yeah, well, it's what they should do is they should sit down with a financial advisor or a financial planner, somebody that they can trust. In other words, somebody that you can pay $4,000 or $5,000 to sit down and honestly go over your life finance. Now, our firm doesn't do that, so this advice is irrelevant to what we do. These type of discussions are the type of discussions that people should really have in their early 20s. They should certainly have these type of discussions before they buy their first home, preferably 2 to 3 years before, because it's the lack of understanding of where your money goes that causes the vast majority of both financial and personal problems in this world today. The vast majority of Canadians, baby boomers for the sake of the argument, who have owned their home for 20, 25, 30 years, should really never be worried about money because they've banked their money in their home. These surveys reveal that regular Canadians don't view their home in the way that they should, and that is your home serves two purposes. Number one, it puts a roof over your head and provides security in your life. Number two, it is the greatest financial vehicle the normal Canadian family has access to. I'm speaking to you this way, Jim, with my own parents in the back of my head. They don't have to worry about the next 10 to 15 years of their lives because they own a home. They can cash that property out at any time and live the rest of their lives on the money that they have stored in the family home. Now, in my parents' case, even though they were the number one realtors, my dad was the number one realtor in the world for 7 consecutive years as part of our team, he still is not at a place where money is not a concern. They have had a great life. They budgeted well. They have no concerns, but then they look at their finances. They can look at their finances today because they can sell the home that they're in. Now, you have to understand, they moved to a northern part of Ontario, and that means that the $1 million house that they lived in here in the Burlington area, their house is worth less than half that where they live now. So they're not going to get $1 million when they sell that house. But what they are going to do is they're going to get enough money that they could fully fund their lives for the next 15 years. Obviously, the people in these surveys are one of two things. Number one, around 30% of Canadian public will be renters. Now, it may drop down to around 25% of the Canadian public by the time you're reaching the 50, 60, 70-year-old mark. So the vast majority of Canadian public are homeowners. But what did you say, 47%? Is that what you said, Jim?
47%, nearly half.
Okay, so for me, 25 to 30% were tenants. So I'm only looking at the 12%, 10-12% of the people that were involved in this survey who own a home who are now worried. Because the first 25 to 30% of that 47 will be made up of people who are tenants, people who've rented their entire lives. You're asking something that is outside human behavior when you're asking people to be tenants their entire lives and then also save the required amount of monthly income, invest it, be prudent with those investments, heed the advice of financial professionals who they can trust. In other words, you're paying someone for the advice. You're not relying on them making commissions based on the advice they give you. You're just asking those people to do something that the rest of us have never done in 100 years. That's not how we live. It's far easier to invest in the family home through paying down the principal each month in your mortgage than it is writing a check for $1,000 a month to a financial advisor. It's way easy to have your mortgage deducted off of your bank account every month, and for that deduction to facilitate the pay down of your principal, which means your home equity is growing. Asking someone to say, okay, I'm going to put my paycheck in the bank. I'm going to allow my landlord to take out my rent payment every month. I'm going to allow my financial advisor to take out my financial investment every month, and I'm going to live with whatever's left over. That's not human nature. Human nature is, it's okay if I make my mortgage payment every month, and as a matter of fact, it's the most important part of my income it's so important that I will commit in writing to a legal contract that the bank can withdraw it from my bank account every month. It's two totally different things. There may be 12% of the Canadian public who's worried. The only reason they're worried is they haven't sat down, they haven't gone over the numbers, or they've waited too late to sit down and go over the numbers, which is a totally different perspective. And that, my friends, is being experienced across Canada today. Because if you missed out in cashing out of the Vancouver housing market for single detached homes in the spring of 2016, you have lost out on your windfall. If you missed cashing out in the Greater Toronto area in the spring of 2017, you missed your financial windfall because you didn't time the market. And when you're a senior thinking about retiring, you need to start timing the market 10 years before the risk of retiring poor takes place.
We'll get to listener questions when Ross K. returns.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross K. Ross, when Canadian banks foreclose on mortgages taken out by foreign buyers, are the banks likely to take possession of the properties without any real recourse to collect their monies owing? And is this a concern for the banks?
Okay, so this is a long, ongoing discussion. I think that we've heard on and off, Jim, probably for the last 5 years. Specifically, this is a big issue out your way in British Columbia, specifically Vancouver and maybe even Victoria. Canadian banks really have had no problem. There was really no risk for Canadian banks. Canadian banks who are forced to foreclose on properties owned by foreign owners generally had properties that started out with at least 20% equity. What that meant was, on the rare occasion, we're talking about an instance where a foreign buyer purchased in 2016 or early 2017 at the peak of the market. And further, they only put 20% down. And now, 2 years later, 3 years later, the bank is looking to foreclose on them. In those rare instances, the bank would be in a situation where it would be underwater, where the bank would not be able to get its money back out. Now, of course, the banks have no recourse against a foreign owner who no longer lives in Canada. You're not going to be going after their assets. Canadian banks do not have a tradition, a history of doing that either. So this is not just a statement of understanding, it's also a statement of historical fact. Is this a concern for the Canadian banks? Well, I will say no. If you look at the amount of mortgage debt that's outstanding in this country, you look at how that debt is structured against the housing stock, you look at where Canadians are in their amortization table versus the price of the house that they're at, you look at the ability of those homeowners to withstand a historical drop in home equity because they are able to do so, the banks have nothing to worry about. So the banks really have nothing to worry about with this teeny tiny amount of their market that's held by foreign owners. Statistics Canada came out with some numbers about the ownership counts. So for the very first time in history, Statistics Canada came out what we asked for. We've been asking for on this show now for 3 years. What are the counts? What percentage of the housing stock is owned by foreign owners? StatsCan finally came up with the answer for that in a couple of the large major Canadian cities. These are not purchases, listeners. This is actual ownership. So aggregated ownership of Canadian homes over decades. What do those numbers come out at? When you look at those numbers, you see the Canadian banks, the vast majority of the discussion that's taken place has been mistaken. So in other words, the sales that were going on in 1 or 2 years were not enough to skew actual home ownership rates in the cities that we're looking at. What it allowed to happen was it allowed local real estate brokerage associations to use purchase price data to give misinformation to the public to support the illusion of house price gains, which is now being wiped out in these housing corrections that are ongoing in both in British Columbia, Alberta, and in Ontario. Quebec will be next. It's not a problem for Canadian banks to deal with a few delinquent foreign owners. They will not collect all of the money from all of those foreign owners, but the vast majority of it, they will. It will not impact the bottom line of any Canadian bank.
Ross, another question. Terranet National Bank announced its 11-city composite house price index had risen 127% between June 2005 and the end of October. Last week, the Canadian Real Estate Association announced its all-Canada composite had increased 126% over those same 172 months, or roughly 14 years. How can those two measures be identical, and is it misleading to pick a date, 2005, and measure it until now to tell us how much our homes are worth?
Well, in terms of the starting date, Jim, so in terms of the starting date, that is a relevant number. The relevancy is provided in that 14-year plus time frame where two supposedly totally different and unique house price metrics have arrived at identical 127% or 126%, 14-year plus change. How is that possible? Terranet National Bank's 11-city composite, by the way, which has changed several times over the last couple of years, been re-indexed, had their numbers changed for those 11 cities only, is 127% more over that period of time. Korea creates their benchmark price of all the homes in Canada, which is a theoretical home that doesn't exist. Korea instead measures bathrooms, bedrooms, kitchens of a fictional house, which then arrives at a house price change. They don't just do it for one house, they do it for all houses in Canada. Now that metric also equals 127% over the last 14 years plus. How is that possible? How is it possible the universe of economists, the universe of university professors, the universe of financial advisors, the universe of government leaders, the universe of Canadian banks have not asked, wait a second, 11 cities measuring repeat sales as the Teranet National Bank House Price Index supposedly does, versus the Canadian Real Estate Association, which supposedly measures every home, but it's a fictitious home created to be a standard home in each location in Canada across several different categories. In other words, literally over 100 different types of homes, but they both are 127%. How is that possible? How have all these people been blindsided by this publication last week and this week? Well, it's really quite simple. As we have said in your show dozens of times, it's called the average purchase price. Regardless of how you want to break it down, you are measuring buyers. What is the average buyer spending? It has nothing to do with the house they're buying. The average buyer is included in the repeat sales by Teranet. What the average buyer is buying is recorded by the Korea benchmark. They're not measuring the same thing month after month. It is a radically different house being measured. For the sake of the argument, we'll use this cycle, Jim, in 2013 than was being measured in 2017. If you looked at those two homes, the average home being purchased, they didn't resemble one another at all. Yet, those homes that were being purchased were the homes that had increased 126%, because you're measuring how much the buyers are spending, not the homes that they're buying. It is amazing that you brought this question up today, because as we know, last week, Statistics Canada released their own brand new house price metric. And it's even more radical because they break it down into new homes, new condos, new detached, and resale homes. Yet, what does it equal over that period of time? The exact same change recorded in Teranet National Bank HPI and the Korea Benchmark HPI. Exact same thing. Why? How can all of these metrics, supposedly so collected with a methodology radically different, result in the exact same thing? Well, because they're measuring the exact same thing. They're measuring buyers. We call it the Cooperative Listing Service House Price Pyramid Scheme. Now, in the 1980s, Jim, virtually every high-volume real estate brokerage in the country understood how it worked. Virtually every president of an MLS association in Canada and United States knew how it worked. The Cooperative Listing Service House Price Pyramid Scheme was discussed at every single real estate convention I attended in that period of time. It was common knowledge. We all knew how it worked. Somehow, in 2019, I guess other than my mother and father in their 80s, who are now retired, and me, we're the only people in Canada who remember those days. Hogwash. It's either been conveniently forgotten or it's been hidden in the past. All of these house price metrics do one thing. They create house price illusion, which becomes a self-fulfilling prophecy. They are inflationary by nature. They are measuring buyers. All of these house price metrics, including the Case-Shiller in the United States of America. He is measuring what a specific group of buyers in a specific month is buying. If they're going out there and spending $500,000, but getting a house that was worth $600,000 last year, it's still going to be recorded as a $500,000 purchase. Just because if they spent $500,000 last year and only got a $500,000 house, but they spend $500,000 this year and get a $600,000 house from last year, that would have cost $600,000 last year, the average purchase price is still a $500,000. regardless of the homes that are being purchased. Teranet National Bank repeat sales will then be recording a home that's substantially superior, yet it still records the exact same $500,000. Thus, it will align perfectly with the Korea benchmark. It will align perfectly with StatsCan. That perfection is why you have a housing bubble. It's why you have the debt load of Canadians that you have today. And it is the only reason that real estate brokerage industry in Canada exists today, as it does. Because if the Canadian public understood how the system works, instead of being 137,000 realtors in Canada, there would be 30,000 realtors. Korea's membership will be cut down to 30,000. They would lose 100,000 paying members. Every real estate board in Canada would lose approximately 2/3 to 3/4 of their members. They would be gone. Now, what I will tell you, Jim, is if that day comes, because it will come, sooner than later, it will arrive, the Canadian public will be better served because house price illusion will no longer exist. The myths about the Canadian housing market will no longer exist. The Teranet National Bank HPI will be debunked. The Korea benchmark price will be debunked. StatsCan's brand new house real property price index will be debunked. The Case-Shiller index in the United States will be debunked. Because I can tell you right now today, Jim, we can debunk these in 60 seconds. You can sit down in our office, if we were willing to show you, with a spreadsheet and debunk these in 60 seconds. That's why they're measuring buyers at 126, 127% change over the last 14 years.
We'll have more with Ross Kay answering listener questions right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked, how is the housing market pricing affected by buyers of income-producing properties versus first-time home buyers?
Oh, good question. Good question. So what I would say to the listener or the questioner in this case, a income producing purchase to us, Ross K. Realty Consultant, is the same as a first time home buyer. It is what we call an initial acquisition. So where that initial acquisition happens across the housing stock will have repercussions in the coming months. So when you're asking buying an income producing property versus a first time buyer, the first thing I'll tell you is, generally speaking, most regular investors are purchasing the same properties first time buyers are buying. They are then going to rent those properties out long term to Canadians. If they are a prudent investor, they will make a substantial gain on their money each month. And over the long period of time, 20 to 25 years, 30 years, when they go to retire, they'll be able to sell that property if they so desire and cash out. I will also say, Jim, generally speaking, a well-structured real estate investment is never sold. It's simply passed on to the next generation. A well-structured real estate investment in residential real estate should never be expected to be sold. You can be a great landlord, make a great return on your money, have great tenants who are not overpaying in rent. That is what a well-structured, well-planned rental real estate investment of income-producing properties is able to deliver. In terms of housing market pricing, if those new buyers, even if they're buying investors buying income-producing properties, enter the new home housing market. They buy a new condominium townhouse for the sake of the argument. There is no ripple effect in the rest of the market because there are no trade-up sales that are a consequence of that. In other words, if someone who currently does not own a home or someone who is buying a second home purchase a brand new build, the benefit to the Canadian economy is you have to create that new house. It is a windfall for everyone. If those investors purchase into the resale market, purchasing a lower priced property, then there will be a series of trades that will happen further up the sales chain as a result of that. That will fuel house price illusion. That will allow organized real estate to claim the housing market is busier than what it really is. It'll allow real estate brokers to convince first-time buyers to overpay for homes. It will allow a housing bubble to inflate more than what it should be. Those are the consequences of that. Generally speaking, though, Jim, this is, again, a consequence of misinformation. It's because the stakeholders in the real estate sales business rely upon misinformation campaigns to make their revenues, to make their profits, to make their businesses work. They're afraid of just telling the consumer the truth. This is the way housing prices are going to go up. This is how they're going to go up long term. This is how much this house is going to cost you. This is what you need to budget. This is what you need to do. They're afraid of giving all those numbers because it's scary, and also because the command of the knowledge required to explain that to a consumer in a way that the consumer just doesn't pack up their bags and run out of your sales office is beyond that of 99.9% of all those involved in the real estate sector now. The amount of knowledge required not only to be able to explain things, but explain it in a way that the home buyer understands it and does not become afraid of it. It isn't taught to anyone. It takes years and years and years of working with these people, and if you have to be self-critical while you're doing it to improve every single first-time buyer or home or consumer that you deal with. It's a consistently improving process, and that's why it doesn't happen. So, in essence, what is the effect on the housing market of buyers buying income-producing property? It allows those who rely on the misinformation about the housing market to earn their business income to create more misinformation. That is what the real effect of the purchase of income-producing properties creates.
And Ross, the question continues, but specifically about income-producing properties in Vancouver, is it time to be buying or selling?
In Vancouver, buying or selling. Okay, so now this question, I'm going to give you one of those answers that I often give in the show. It's always a great time to buy investment real estate. At the same time, it's always a bad time to buy investment real estate. Income-producing properties anywhere in North America. I'm not going to pass comment on the other side of the ocean, folks. I only know North America. And our specialty is Canada. You have to look at each income-producing property differently. Each income-producing property requires a certain return on the investment to eliminate risk. If that property cannot return that rental rate, then it is a bad time to buy that property. If that property can produce that rental rate, it's a good time to buy that property. But it is unique to each property. We often get people who ask us about a specific property, and we'll give them what the rental is needed from that property to make it worthwhile. And then they'll ask us about another property that they believe is comparable because it's the same price point. And we give them two radically different rental rates that they have to be able to get out. And then they come back and they say, well, you said last time on that property it was $300,000 or it was $600,000. We needed to get X. Well, we're looking at the same price in this one, and you're telling us we need to get Y. And our answer is, yeah, that's exactly what we're telling you. Because we look at these properties different. These properties have a 30-year cost of ownership profile. This is the exact same way we talk to consumers when they're looking at a property. And it's why house price illusion is such a problem. If you sit down with a consumer today and you explain to them what their cost profile is over the next 30 years of owning a home, it is way different than we used to have to tell them when I started selling real estate in the late 80s, early 90s. It is two totally different worlds. It is the magnitude of cost years ago in the late 80s, early 90s. It was so high compared to what it is today. Yet I read these affordability articles in the paper, these complaints by millennials in the paper comparing against boomers, and it's just something else rooted in myth. It's rooted in you're not looking at the 30-year cost of ownership profile of a home. Why does that happen? Number one, the knowledge required to deliver that 30-year profile. It doesn't exist. You had to have collected it over the last 30 years. CMHC doesn't have it. Nobody has it. You had to have collected it. You had to be proactive in how you viewed these things. So when we're talking about is it a right time to buy an income-producing property in Vancouver, we would say, what property? And that would be the start of the conversation, because our calculations would be the exact same today that they were 3 years ago, that they were 10 years ago. The calculations that we use right now are so fine-tuned that it's virtually impossible to make a mistake. The only mistake you're going to be made if you set an ownership timeline, an investment timeline, and then you change that investment timeline in the future. Okay, well then that's your fault. You've changed things up. So the answer to Vancouver, is it a good time to buy income-producing properties, is yes and no. It depends on the property. It depends if you're getting the information required to make a logical, rational decision based on the investing terms that you're looking for, your investment horizon, and the property you're looking to invest in.
Ross, what I'd be looking at then is the property costs the same, but I would be asking questions like, how new is the roof, or how old is it? Are those new appliances, old appliances? How old is the carpet? How old is the furnace? How old is the air conditioning? Those would be major factors, wouldn't they, in deciding whether that's a good investment property or not?
You know something, Jim? You just hit the nail on the head right there. People go out today. So there will be this year around 400, by the time it's done, there'll be around 415,000 resale homes purchased today. So I don't care what the Canadian Real Estate Association says. There will be around 415,000 resale homes sold this year. Now, that means you got to not count the double sales. It means you can't count the new homes that are counted as resales. It means you also have to add in some for sale by owners that are not going through cooperative listing service. So all of those purchases, there'll be around 415,000 resale homes that will actually trade hands this year. Each one of those properties has a different 30-year cost of ownership profile. Their roofs are never identical. The age of the roof is never identical. Even two houses built by a new builder on opposite sides of the street, 13 years from now, will have a different lifespan on their roof because of the orientation of the roof to the sun. The winds, whether or not the gutters were taken care of by the owners. If there was a tear from one nail was not hammered properly when the shingles were installed. All of those things change. Nobody wants to deal with this because it's too complicated. A real estate agent just looks at two houses on the street and says, Joe got $300,000, I can get you $305,000. That's how it works. It doesn't matter if your home's not as good as Joe's. Joe got $300,000. So now Sue wants $305,000. The realtor wants the listing. They listed at $305,000. The second that listing is signed, the second the owner signs on the dotted line, the listing agent is required by law to support the $305,000 price. It doesn't matter that Joe only got $300,000 and Joe had a brand new roof. His driveway, there's a $4,000 or $5,000 expense, was resurfaced last year. He had a new interlocking patio installed in his house. His furnace was replaced 3 years ago. Meanwhile, Sue's house is 15 years old. Joe had his insulation upgraded in his house. Sue's is still as the builder installed it. On the surface, both of those houses look identical. The real estate agents treat them as identical. We don't. We treat them on a 30-year cost profile. All of these things are itemized. Each individual house that we view, we are able to come up with a cost profile on. Now, imagine being a home buyer, buying a house and spending $500,000, and versus your friend who spends $500,000, but didn't have to spend an extra $120,000 owning that house over the next 30 years. Who would you rather be? I'd rather be the person who didn't have to spend the extra $120,000 owning that house. These are the huge numbers that we're dealing with. The reason why the platforms that we are facilitating can operate the way that they do. The reason that we can give our no-risk, zero-cost formats is because the numbers are so huge. We save 20, 30, 40, 50, 60 times the amount of money for those people who are on our platforms than we have to guarantee. We can't make a mistake. There's so much involved. A simple roof, for the sake of the argument, Jim. A simple roof on a single detached home. If your forecast for the cost of that roof is out by 3 years, you're talking an extra $4,000 on average over a 30-year window. That one little tiny mistake. The furnace. Let's look what's happening out in British Columbia. You've got the rebates that are available right now. If you own a home and you are not taking advantage of those rebates, and in the next 5 years, your ownership cost profile says you're going to have to be installing a new furnace, and you're missing those $2,300 rebates right now. The only reason you're missing it is because someone hasn't told you. So, yes, when we're talking about these things, Jim, it's exactly the same. An investor or a home buyer who's going to live in the home themselves need to start talking about real estate in a totally different way. They need to start talking about it with truth. They need to stop listening to the myth. A $500,000 house is not going to cost you $500,000. It could cost you $1 million by the time through 30 years of ownership. It could cost you $700,000 through 30 years of ownership. And if you had purchased it in 1990, you probably were going to pay 3 times what you thought you were paying when the real estate agent got you to sign on the dotted line.
And Ross, finally, we have another listener question to wrap up the show. Is there really a Royal Bank Newcomers program that allows new residents to buy homes with no credit check needed?
There's not only a new Royal Bank, Jim. There are multiple banks that have these programs. Not only that, they're backed by CMHC and Genworth, the 2 mortgage default insurers in the country. The programs they have, in some cases, are so much better than what they offer Canadian families. I think there would be an uproar if Canadian families really understood what was going on. Some of these programs, Jim, they will allow new residents into Canada, not even Canadians, new residents into Canada, not Canadians, they're not Canadians yet, to buy homes without a credit check. Now, can you imagine, Jim, they're allowing some new families in this country to buy a home without a credit check? There is not a Canadian family that can purchase a home without a credit check. There is not a newcomer to Canada who's been here for 2 years who could buy a home now after being here for 2 years without having a credit check. Yet, some of these bank programs, that's exactly what they're offering. The secret with most of these programs is now and has always been, Jim. So when I say has always been, that means going back to when I started in the real estate business in 1987, 20% down. The 20% down is the magical number. Now, there are many ways to reach that 20% down, even if you don't have 20% down. That is practices that are commonly followed. But that's really what this comes down to. So yes, it's true. The Canadian banks offer non-Canadians, new residents to Canada, better terms and conditions and better opportunity than they're willing to extend to Canadians. That is the truth. There's no debating this fact. All we can hope is that those new families coming here who happen to take advantage of these programs have a desire to stay here and become Canadian. That's all we can hope for. We also have to be truthful about the fact Canadian banks treat Canadians worse than they do new people to this country.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
If you have any questions for Ross, who is the home ownership consultant at thewealthyhomeowner.ca, you can send them to info@housestreet.com. Find us on Twitter at House Street. We're also on Facebook. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.